months of 2018 have been eventful, to say the least. We've experienced on-again, off-again trade war threats, interest rate increases, discord in Europe, and a lot of shifts to both extremes in relations with North Korea. These are just a few of the major news stories we have all been following so far this year. And some investors have been spooked by the headlines, and it's really not hard to understand why. But the question is, have these events actually hurt our economy? Do they suggest that bad times are ahead? What can we learn from all this? So let's look at what's really going on, and then we'll try to get a sense of what we might look forward to for the next 6 months, second half of the year, and beyond. First, let's talk about volatility. As I said above, headlines have inundated investors so far this year, and the market has reacted sometimes violently. In fact, the market slid 12% in early February when it was clear that inflation was starting to kick in. Even though the market did recover from that drop, the volatility is still with us. Now, keep in mind that we're in one of the longest lasting bull markets in history. Investors are rightfully concerned, asking themselves, when are the good times going to come to an end? Now, it's impossible to know when or how that might come about, but we're still worried about it. And as a result of that fear, investors often overreact to headlines, and as a result, we have a lot of volatility. That's why it's felt like a roller coaster this year for many investors, but the actual results are kind of tame. The S&P 500, for example, is up just about 1.7% so far this year, and the Dow is down 1.8%, and many international markets are somewhere in the middle. Let's talk about trade wars. The most obvious and current challenge to the economy is the threat to trade, specifically with China. As I write this, President Trump is set to slap 25% tariffs on $34 billion worth of imports from China. And this is supposed to take effect July 6th. If that happens, China has already said that they're going to respond in kind, so tensions are very high. Everyone knows that trade wars are not good for anybody. But is there any room for optimism? Maybe. First, at the same time that President Trump threatened to take harsh measures against the Chinese, he moved to reduce the tension in other ways. First, he gave one Chinese tech company, ZTE, an exemption, and he also pedaled back on some of the more aggressive rhetoric. And let's not forget that it really takes two to create a trade war, and China is motivated to find a negotiated settlement. That's because they have a lot to lose in a trade war too. Even before the tariffs were imposed, just the threat of the conflict knocked the Chinese currency and the Chinese stock market down several steps. In short, China has many reasons to resolve this problem with the United States. Now, if we consider this practically, even if the tariffs are imposed, they can be lifted quickly if the sides come to an agreement. What I'm trying to say is that if trade tariffs are put in place, it doesn't mean that they'll stay in place or in force for any period of time. It could be for a long time or it could be for a very short period of time. For all these reasons, my take is that the tariffs and trade war talk is more negotiating tactics than anything else. Of course, I could be wrong, and sometimes things take on a life of their own. Either way, clearly the trade war is something I'm monitoring carefully. Let's talk about interest rates. Another point of concern are interest rates. Short-term rates are going up. That's no surprise. And historically, when the 2-year yield is greater than the 10-year rate, that's called an inverted rate curve. And historically, when that happens, it's a signal that there could be a future recession. Now, rates haven't reached this level yet, but they are close. Now, obviously, the Federal Reserve Board is well aware of this, and that could slow their plans to increase interest rates. Also, the trade conflict I just talked about mentioned, it's already impacted our economy, and we're already starting to see some elements of the economy slow down. This might stunt inflation without interest rate hikes. So it's another wait and see situation. Let's talk about inflation and energy. And when you talk about inflation, it's important to consider energy prices because when oil prices rise significantly, it adds to inflation. Oil is currently trading at over $74 a barrel. That's the highest level since 2014, and it could get even more volatile soon. That's because President Trump has asked our allies to stop buying Iranian oil, which of course takes supply off of the market, and that in turn could push prices up. But at the same time, Saudi Arabia has been asked to increase production to make up for the embargo on Iranian production. That could help stabilize or reduce oil prices, and either way it's going to impact inflation. So we've got to continue to watch that as well, because that will obviously also bring back a force on inflation. Talk about corporate earnings for a minute. The S&P earnings grew more than 20% in the first quarter of 2018. That's the first time it's been that good in 8 years. Also, almost 80% of the companies reported earnings that were higher than they expected. And that's also really good news. The thing is, it hasn't really translated into soaring share prices. Usually stocks move higher as corporate earnings grow. So this phenomena is interesting and potentially very important. It could be explained by a variety of reasons, but we can't be sure what it means right now. For now, let's just agree that earnings growth is strong, and if it continues to match or beat expectations, it's a good thing for investors, all things being equal. Let's talk about the elections. You'll hear a lot of talk about the elections coming up. It's a wild card. But the outcome of the coming election is impossible to predict. And it makes no sense to try to pre-position our portfolios based on events that are yet to occur. As long as the results are not lopsided either way, I don't see this as a pivotal event, although you'll hear lots of people say that it will be. Bottom line, let's bring it all together. Right now, economic optimism is high. Consumers feel that their financial situations are improving. Unemployment is at the lowest level it's been in 50 years. And the consensus is that our GDP will expand at 3.5% for the next 2 quarters. These are really good things. The tax overhaul didn't do much for investors, but it's been a huge accelerator for business. So if business spending continues to expand and inflation stays moderate, earnings could continue to be strong and the market could do well. But as I said, it's a choppy market and investors are skittish. That's going to make it difficult to remain calm for many people. But I urge you to try to do so anyway. The markets will be volatile. That's the nature of the beast. I believe we're on the right path, and I'll continue to monitor the situation and make changes as required. If it makes sense for you and me to talk or meet based on your current situation or anything else, please let Kim know in my office. She can be reached at 818-889-6700, extension 3. And she'll set up a time for you and me to speak or meet. Thanks and have a great summer.